Hi, my name's Mike Minter at Main Street Financial Solutions. I am doing a short video that I call Pigs Get Fat, Hogs Get Slaughtered. And we're going to go over three different charts. These are my own opinions and not those of my firm. Why am I doing these? Really just to help whoever wants to hear of what I'm looking at and kind of my knowledge in this business. Regardless of how much anybody has, I want them to see what I'm seeing. If they make changes, great. If they don't, that's fine too. So let's hop into it. The first chart I'm showing here is the S&P trend channel, and this is a chart that goes back a century. And it takes a snapshot in time of all the bull market peaks and all the bull market troughs or bottoms. And it takes a snapshot of what the price to book value is, the price to dividends, price to earnings, and it does an average for all the peaks and all the troughs. As far as T-bills and T-bonds go, we're not really going to focus on them because we are in that area right now of interest rates. It would be more significant if we were much lower or a lot higher than we are today, but that's about where we are. So we're going to focus on valuations of the S&P 500, mostly during bull market peaks. So that would be B, E, F, G, K, L, M, and O. So B, E, F, G, K, L, M, and O. During those periods of time, when you take a snapshot, what was the average price to book value at those peaks? It was 2.9 times. Where are we today? Or at least when this chart was generated at the end of November of last year, price to book value 4.9 times. So not just at the averages, but significantly above the averages. Same thing with price to dividends, 49.6 versus price to dividends today of 82.2. Price to earnings, 20.1 versus 26.6. If you want to break down all of the circles and try to look at all of these peaks and see if any of them are comparable to here, I would say your best one would probably be March of 2000, right before the tech bubble burst. We had a price to book of five times versus the 4.9, 89.4 for price to dividends, 27.8 for price to earnings. This is the second time, if you're not including the Great Depression, of us breaking through the top end of this trend channel. Happened during the tech bubble, and now it's recently happened again within the last couple of months. Now, it's not a timing tool. We've talked about this in the past, even during the tech bubble, when it broke through the upper end of the trend channel, lasted for a couple of years before the market eventually turned. Could that be the case this time? I don't know, but I do know that where current valuations are compared to history, very high. That puts up a little bit of a red flag for me, even though it's not a market timing tool. Second chart is kind of the behavioral finance chart. And it's one of the reasons why I call this pigs get fat, hogs get slaughtered. If you're following the herd, eventually you're going to get slaughtered because when you believe in the optimism and the euphoria that everybody else has, these are typically the periods of time when markets get to these extreme valuations, and then when they turn, have also a significant decline. So the dark blue line is the household equity percentage. It's not everybody, it's just people with investment accounts. So half of the population isn't even included in this because they live paycheck to paycheck. And the left scale is the actual equity percentage. The dotted line is the subsequent rolling 10-year return, and the scale is on the right side. You'll notice that the dotted line is 10 years behind where we are today, which makes sense. If you took a snapshot today and what are the returns going to be 10 years from now, we have no idea. So it's always going to be 10 years behind. We'll take a look at two periods of time. 1982 which was right before the greatest bull market of all time in this country, and 2000, right before the tech bubble burst. All right, so in 1982, this is years of double-digit inflation coming out of the late 70s, early 80s. Stock market was not doing very well. The lowest percentage of equity allocation at that time, which is, if you draw a line to the left here, about 26%, we'll say, the household equity percentage. What was the subsequent 10-year return? Go to the dotted line, go to the scale on the right. It was about between 18 and 19% annualized return from 1982 to 1992 if you were in the S&P 500. Unfortunately, most people were not. Then we go to the tech bubble. Was incredible technology. People thought we were in a new paradigm. Valuations didn't matter very much. Well, that's when we got to the all-time high of 65% household equity percentage. What was the 10-year annualized return after that? It was minus 3%, which also factored in the great financial crisis. But still, you get optimistic when everybody else is getting optimistic and start trying to chase returns. This is very similar to the institutional money. You look at mutual fund cash holdings, they're at a record low. So when everybody is fully invested, you need to kind of start asking yourself, who's left to buy? With a chart like this, 0.81 correlation, it's a pretty strong correlation until recently. We've got a big gap here. Why do we have that gap? Again, this is what I believe with the $30 trillion truth, which I recorded before, because of all the debt accumulation and spending that we've been doing. Now, why do I show this chart again? I show this chart again because we now have a Department of Government Efficiency, or at least we will in another 2 weeks. That is saying they're going to slash the wasteful spending and they're going to cut $2 trillion out of the deficit, which should get us to basically balance the budget. It wasn't that long ago when we actually did it, late 90s, early 2000s. But, if they do that, what are the consequences? And the consequences of that will be there will be a lot of job losses, I would think, especially in the government sector. And there's going to be a lot of services that are no longer going to be offered that people are used to using. So, when you look at these three charts, valuations, extremely high, behavioral finance, what everybody else is doing, and knowing that if this is one of the reasons why asset prices are where they are today, you keep throwing money at problems. This is why correlations have kind of gone away. You shouldn't have record highs in just about everything. We're talking stocks, we're talking real estate, we're talking precious metals, we're talking crypto. Even when we go back to the investor psychology, right? 1982, when no one was invested in the market. 1982, no one's invested, and look where valuations were at that time. It's at the bear market troughs, extremely low levels. Great time to be a long-term investor. When everyone piles in the markets, like a year like 2000, well, where were the markets then? Above the trend channel, very high. We all know how that ended. So these are the types of things that I wanted you to see. Again, whether you use it or not, that's up to you. If you've done very well in the market up to this point, I would highly recommend taking some of your chips off the table, but completely up to you. When I look at these things, definitely makes me concerned moving into 2025. That's it. I hope everyone had a safe and healthy new year, and we'll continue to have a healthy new year. Thank you for listening. Bye-bye.